Brad Williams, Frugal Finance Mortgage. Here's a question. What is the difference between a fixed rate and adjustable rate mortgage loan? With a fixed rate mortgage, the interest rate is set when you take out the loan and will not change. With an adjustable rate mortgage, the interest rate may go up or down. Many ARMs will start at a lower interest rate than fixed rate mortgages. This initial rate may stay the same for months, 1 year, or a few years. When this introductory period is over, your interest rate will change on a regular interval, and the amount of your payment is likely to go up. Part of the interest rate you pay will be tied to a broader measure of interest rates called an index. Your payment goes up when this index of interest rate increases. When interest rates decline, sometimes your payment may go down. That is not true for all ARMs. Some ARMs set a cap on how high your interest rate can increase at any time over the life of the loan. Some ARMs also limit how much your interest rate may decrease at any time or over the life of the loan. The caps may be different for the initial change versus the subsequent regular interval changes. So let's say you start off with a 4% start rate. You have a index, let's just say it's the 1-year treasury. It's a year past and the max increase would be 1%. So you're looking at the index. The 1-year treasury is at 4%. It can only go up 1%, so nothing happens. Next year, it goes up to 6%. The max your rate could go up would be 1% because you have a 1% index. So now your rate's going to be 5%. Then there could be a cap. It's usually 6% over your start rate, which was 4%. The maximum you would pay would be 10% on your loan, would be 2.5 times your current mortgage amount. Ouch, that could hurt. A lot of people have fallen into that trap. You have to understand the index and the cap. You also have to understand the volatility of the 1-year treasury. It is very volatile. In other words, it goes up, it goes down, it goes up, it goes down. It's like a teeter-totter. Interest rates can move down as fast as they move up. Make sure if you do an adjustable rate mortgage, terms and conditions, this is a question you're going to have to ask. Say, look, I understand interest rates can go up, and that's never favorable. But I also want the benefit of the rate dropping and my payments dropping in accordance with rate increases. If it's not matched, then shop around for another adjustable rate mortgage. Know how your margin, I said there's that index. I said it was 1%. I meant to say it was the margin. Then there's the cap. Some ARMs set a cap on how high your interest rates can increase. That would be that 10% I mentioned. Some ARMs also limit how much your interest rate may decrease. The caps may be different for the initial change versus the subsequent regular interval changes. Your actual rate and the time of change will be based on the new index plus a set margin, subject to any caps. Sometimes it's 2%. That's pretty aggressive, the margin. I would shop for the lowest possible margin, the least volatile index. The prime rate moves whenever the Fed makes their change. The problem with the prime rate is it is very slow to move down. As opposed to the 1-year treasury, that's a day-to-day adjustment. Keep that in mind. The margin is a number of percentage points added to the index by the lender that sets your interest rate. Know how your ARM adjusts before taking out an adjustable rate mortgage. Find out how high or how low your interest rate and monthly payments can go with each adjustment. As I stated, if you went from 4% and the index went to 6% and there's a 1% margin, it would be 5%. You can have an adjustment every 6 months. It could be annual. My suggestion is to try to get a margin that only adjusts annually. I know that's pretty aggressive. How frequent your interest rates will adjust, how soon your payment could go up, if there's a cap on how high your interest rate could go up, if there's a limit on how high or how low your interest rate could go, if there's a limit on how low your interest rate could go, that's critical. If you'll still be able to afford the loan if the rate and payments go to the maximum. Like I said, you're going to have this max cap. If that is 10%, can you afford that? If you're shopping for a mortgage, check out all my other videos. There's a bunch of links in here. I'll leave this article posted below. Comment, let me know what you think. If this is confusing, Do you understand what an adjustable rate mortgage is? Do you understand what caps are? Do you understand what the index is? Do you understand margins? Do you understand negative amortization? Do you understand the workings of an adjustable rate mortgage? Comment, Brad Williams, Frugal Finance. Hope that helped. Thanks for watching. See you soon.